Most customers of small businesses typically purchase products on credit. In other words, they promptly provide the goods and services, send an invoice, and then receive payment a few weeks later. Businesses keep track of all the money their customers owe them using an account in their books called Accounts Receivables. Here, we'll discuss what is Accounts Receivables, Accounts Receivables Meaning, how Accounts Receivables function, how it differs from Accounts Payable, and how good Accounts Receivables Management may help you get paid more quickly. What is Accounts Receivables? Accounts receivables are the unpaid bills or cash owed by customers for goods or services delivered or used but not yet paid for. They are a company's line of credit, typically requiring payments within a short time frame, typically ranging from a few days to a fiscal or calendar year. Businesses include accounts receivables as an asset on their balance sheets due to the customer's legal duty to pay the debt. Accounts receivables can be pledged as security against a loan to cover immediate expenses. Why Accounts Receivable Management is so important. Accounts receivable is a vital part of a balance sheet because it represents bills that should be paid to a company and could require steps for collection. Payments of accounts receivables can lower a business's debt, lower financing costs, and enhance cash flow, which can then be used to raise dividends, invest in CapEx, raise risk capital, or provide new products and services. The accounts receivable process. When a business sells a good or service and includes payment terms, discounts, or credit guidelines in an invoice to the client, the accounts receivable process begins. When payments are received, receipts must be given back, and the payment must be noted. Companies must have strict policies in place for extending credit, promptly collecting unpaid debts, and maintaining accurate client information. Payments must also be applied to the right client and specific invoice in order to maintain accurate accounts receivables. A corporation may employ an accounts receivable clerk whose responsibilities include monitoring accounts to see if they are past due, calling clients to prompt payments, answering client inquiries, maintaining accurate records, and bookkeeping. An aging report is used by a company's collections department to keep track of and display unpaid invoices from clients along with the length of the bill's existence, typically in increments of 30, 60, 90, or more days. A company's ability to recover payments and lower its accounts receivables can be assessed using an aging report. A lot of companies also market software for automating accounts receivables administration and connecting the procedure with an ERP system, including Oracle, Workday, and SAP. Accounts receivables FAQs. Accounts receivables versus accounts payable. Accounts receivables and accounts payable are two financial metrics considered by lenders and investors. Accounts receivables represent client-owed money, while accounts payable represent liability owed to another company. Both are essential for business financial health assessment. Is accounts receivables debit or credit? Accounts receivables are cash inflows that creditors receive based on market trends, representing transaction exposure. Debit means assets, while credit means liabilities. Accounts receivables represent transaction exposure, benefiting an entity directly or indirectly. The golden rules of accounting determine which type of account should be debited and visible on the asset side. Accounts receivables journal entries. Accounts receivables transactions are recorded in a company's accounting records as accounts receivables journal entries. These entries are the foundation of an organization's accounting system, tracking each commercial transaction. The general journal or general ledger is used to record raw data, including transaction details, organized chronologically according to the transaction's date. The general ledger is the main accounting document, and all financial transactions are compiled there. The information in the general ledger is used to create financial statements like the balance sheet, income statement, and cash flow statement, which support analysis of the company's finances and performance. Accounts Receivables Turnover Ratio. The accounts receivables turnover ratio is a crucial measure of a company's ability to convert outstanding bills into cash. It measures the number of times a company collects its average accounts receivable over a year, which can be used by banks to assess repayment likelihood or establish interest rates for lending based on a business's accounts receivables. Accounts receivables are a crucial component of a company's basic analysis. As a current asset, it reflects a company's liquidity or its capacity to pay short-term obligations without the need for further financial flows.